Hi everyone, this is Keith from Investment Modes, and today we're going to talk about quite. I'll try to provide an answer to a question that I get quite often, and probably something that some of my colleagues get quite often as well. And I call this the title of this topic: Why off-the-shelf income products do not solve your income needs, because today we're going to talk about income, which means that it's somewhat related to the topic of financial independence. Now, this is a question that I get a lot in sometimes privately or even in chat groups or from friends, which usually how it goes is, what do you think of this fund product and strategy? And often it will be something like what you see on the background is either some insurance plans or some income funds, or someone purchase a property and then they think that this is a good strategy to actually get the income. And usually I will struggle with answering them because when it's phrased this way, right, like I have no idea what you're actually looking for. Like, I think every one of us are interested in income, but like what sometimes we need more details to actually work with. But what I realize is that I have this kind of a philosophy that whatever that they're looking at, right, most of the time, right, these stuff, right, they're not gonna get it from off the shelf, which means that these stuff that they have, right, is not gonna be able to fulfill what they are actually looking for. And in a lot of sense, I think it's because they don't approach this topic in the right way. Most of the people I encounter outside, they are quite product focused. Some of these things are sold to them. So in a way, I don't think they're looking at things the right way. But how what's the right way to actually look at how, if let's say you're looking for income, whether it's for financial independence or providing some income to satisfy some goals. Today we're gonna show you like roughly some of these things that you should take note of to actually consider. Okay, when we're talking about products, right, we are like off-the-shelf products, right? This is roughly how I'll classify them. Probably some kind of retirement income insurance plan. It could be universal life plans as well, because right now most of the insurance plans, they are a structure by itself and they tend to be quite flexible, and your banker will sell that flexibility that you can actually get income from them. But universal life policies tends to be more for legacy planning, and if you get income, I'm not sure how much legacy stuff is actually left at the end. And of course, there are unit trusts or ETFs that distributes dividends, some of them high dividends. If we look at individual companies or the bonds or fixed income that is provided from that you can buy from listed exchanges, right? Those are considered off-the-shelf products as well. We can consider some of these investment strategies, popular investment strategies, as kind of like solutions or strategy that people think that these will actually be able to provide income by itself, because most likely you're not going to put all your wealth inside one stock or one fixed income. It's usually a portfolio of it, and there's a certain strategy how you think about getting that income. And last but not least, properties. Singaporeans like to a lot of people think that if you are able to buy a property, pay off the mortgage, right, and then you can get the income, right, that should fulfill your retirement needs. Yes and no. those things do help, but I don't think looking at it from a product angle is correct. So how should you look at it then? Okay, we tend to look at these things, right, as there are certain characteristics or things that you should look out for. I tend to group them either from the financial planning or wealth planning side, and then the other part is the investment side. So let's look at the wealth planning side of things. So these are some of the things that you should consider. Firstly, you should need to consider like what is the kind of financial goals that you are that these income products or strategy is supposed to be planning for. What is the thing that you're trying to solve? Are you trying to plan for your retirement? And whether these things, your intention is to put all your money there or what? So what are the financial goals? Or you're just trying to accumulate. You just have an affinity towards this product, but actually you're in an accumulation stage. So that is important. Okay. You should think about what's your overall income strategy, because a lot of times people look at it as a product. They don't have a overall income strategy. And I can tell you upfront that there are no perfect products out there. A lot of these solutions out there, right, they have their flaws and good points. So we probably need someone to actually like gather them up, right, and then try to design things around the flaws. But what is this overall strategy by itself? This is something for people to consider. I don't think a lot of people have an overall income strategy. They probably have an investment strategy, but do they have an overall income strategy? I doubt a lot of people have that. Okay, there are probably about 6 different characteristics that you can think around when you look at, let's say, this insurance plan or what. Then these characteristics, right, they are more of the financial planning and wealth planning side of things, and they are closer to whether they are able to satisfy the financial goals or not. These characteristics are like, how consistent will the income be? Is the income inflation adjusted? How long will the income last? Some important questions. How much effort do you as a client or portfolio manager need to spend managing it? Okay, and the last 2 are less important, but the number 5 is how scalable is this product? Whether if I have $50,000 or $3,000, right, can I buy them? Or in the case of properties, we know the answer, like it requires such a large down payment. And the last one is whether, how sure are you that they are able to deliver? This is a good question to ask. So whenever you look at these kind of things, these are things that I think you should consider that is closer to the wealth planning side. And today we will try to flesh out why these are considerations, and we try to use some of the examples of these off-the-shelf products to show you that it's not they are not not all of them they will fulfill these criteria. Okay, so on the investment side, it is just one thing. Okay, we are concerned about the total returns, like how much, if you're evaluating between these different products itself, right? How are the returns like, and what drives the returns? This is a very common question to ask. And what drives the returns, right? They tend to be what is the underlying asset allocation and the manager strategy, which means that you have to ask the further questions like, what is the underlying asset allocations? Is it stocks, cash, fixed income, properties, or some I name them as weird scam assets, because some people talk a good story, right? But actually, like this whole thing is a scam, So what drives the return, right? There's nothing inside there. It's just fluff. And of course, equally important is like what's the strategy? Like some managers, they have a certain kind of strategies. Can you articulate them? and whether there's empirical evidence that shows that these managers can deliver the return. Okay, so most people I know, they are looking for a certain holy grail when it's come to income, and it's about these 5 things over here. Consistent income is inflation adjusting. This income, preferably it lasts intergenerational, which means that you can pass it on. That's why people like freehold properties a lot, and they don't want to spend too much time managing it. It needs to be passive and all. And best is that you don't need so much capital to get started, and you can, whether your capital is 50,000 or 50 million, it does work. Now I'm gonna tell you, right, this is not possible lah. Like, I've seen enough things, right? All the strategies outside there, right? They don't fulfill these 5 things. Okay, they struggle with it. There's probably some things that you can do, right, to actually get this holy grail. Okay, but you can't find it in the off the shelf products. There are some out of these 5, right? Probably these 2 is what I think is like quite challenging for someone that is a product designer to provide. The income, inflation adjusted income is a big one. Okay, and I think most of these strategies, they require some sort of like intervention from the person that buys a product. Okay, now let's look at the 6 wealth planning. About 5, I'm gonna look at 5 of those characteristics that you should think around. The first one, right, is income consistency. Like, how consistent is the income, and this will let you know whether it matches your needs or not. What I tend to realize is that whether it's stocks, fixed income, or the products out there, insurance products, income tends to be less consistent. And we're using the first example over here. If, let's say, you're thinking that if you buy a property, you can have consistent income, I don't think so lah. And we have empirical evidence of the last 10 years. What you're seeing over here, right, is you can take from these URA websites what is the gross rent that is actually collected for different kind of properties. In this case, we're having Cover Melody. We plotted out a certain specific size of the rent. How much is it renting for per month? And you can imagine that, suppose in 2012, right, you purchase Cover Melody for a certain amount, and you find that if, let's say, you have, if your income is like that, after the expenses, it covers, you can retire, right, and then you stop work at this point, and this income is probably around $4,300. Let's say it includes the cost that it takes to actually maintain the property. This was in 2012. Probably in 2016, right, the income drops closer to about 3,009. Okay, and then probably in 2018, you can only renew the tenant's rent at around 3,001, 3,002. So that's like about 30% difference. But we know that eventually now it picks back up. It goes back to somewhere close to $4,500. But if you are not working, you live through this experience, this income is not so consistent. And we haven't even talked about inflation adjustment. Now, it's not just Cover Melody that shows this kind of inconsistency. If let's say we can have data from different kind of local condo projects, and while some of them, they show more consistency, like you look at Travel Spark, right, it's more consistent. This is a more higher end, 5,000 plus, right. At a certain point, it dips below 3,009 as well. So this is something to think about. Let's move on further. Next is, I think some of these unit trusts that pays a good dividend yield, a high dividend yield, right? They look appealing as well. But we can take a look at their dividend paying history. We can use the same kind of idea that if let's say you go back to 2012 or 2013, right? You put in $1 million and think that, okay, a fund or a portfolio of funds similar to, let's say this one is Alliance Income and Growth, right? It should give you consistent income. But you realize, like, if you last until May 2023, right, your income instead of 0.075, it is now 0.0555. Now it's actually lower. We have another example over here, which is Fidelity Global Multi-Asset Income. This one I think is more consistent. I actually got this from a friend who looks into these kind of things more. The current historical monthly dividend distribution is about 5%. So it looks consistent, but there is also some slight differences over here. So there are some that is actually more consistent, but you will realize that this takes place more than something like this. Now, REITs is also popular, a popular dividend strategies, and on the left side we have one of the most popular REITs, which is an industrial REIT from Mapletree Industrials. What you realize is that this is a good example of a well-managed REIT where you can see the dividend per units at the bottom, right? It goes up over time. It starts off with about 8.4 cents, which eventually progressed until 13 cents. So that looks like a good growth. But if you bought it somewhere in 2022, you will tend to see that your dividend per unit dips. So it's not a given that this income is actually consistent. On the right side, I've tabulated. I've taken from an article where I tabulated some of these different real estate investment trust ETFs, their distribution over time. There's inconsistency as well. Like this one is like 0.052 cents, and then now eventually it's like half of it. And these are the actual distributions. You can imagine that investing in them in 2019, right? And then what you'll be getting today. These two tends to be more consistent. I think we can consider them to be consistent enough. So while the individual real estate investment trusts, right, some of them might be more the dividends might be going up, some of them might be going down. But if you manage them in the portfolios, right, it can achieve some kind of consistency, but also it's not a guarantee. Okay, now it's not saying that if it's not consistent, right, it's the end of the world. Now these illustrations, right, is something that I've written in some of my past articles, where I say that if you want to build wealth sustainably or in a sustainable manner, right, you have to acquire the knowledge to operate it well. And this is a good framing to how to think about it. So imagine that you are a portfolio manager, that you have a role to play. You have some responsibility involved, and you probably have a certain strategy, whether it's a dividend income strategy or you prefer a more value investing based approach. There is a certain strategy. You need to do some kind of execution and monitoring and some sort of portfolio rebalancing as well. And as a manager, you control the decision, right? Whenever you have income coming in, right, you deposit them as a certain cash holdings, right? You have to decide whether you invest in individual stocks or certain kind of insurance products or certain kind of funds itself. And if you get some of these income or some of these once you sell off some of these holdings, right, it still stays within this loop by itself, and you are in control whether to actually pay out this income when you need it, how much you pay out. Essentially, this whole thing, right, you can look at it as your own self-managed fund by itself, which is a good framing if, let's say, you didn't realize that if you don't do it yourself, let's say in this fund one, right? If you look into fund one, right, it will look something similar to this as well. So you can imagine that there is, you can zoom in, and then it will look something like that. Now, to make income consistent, right, that means that you, the portfolio managers, right, because you wear the portfolio manager's hat, right, you have the power to actually make it more consistent. But the question is, how do you make it more consistent? That's not the topic. That's not what we want to go into for this this video podcast discussion. We'll leave it for another time period. Okay. Most of the shelf products, right, I do find that they are not gonna adjust for do inflation adjustments, and there are some good reasons for it. Okay. Most of the shelf products, right, they serve many types of individuals. So the product designers, right, they cannot cater for all of these kind of scenarios. So because of this, right, usually these products, their income profile, right, they tend to be very conservative. What this means is that even if, let's say, they guarantee a certain amount, or even if there's inflation adjustment, it's for a limited time, or that it's not exactly guaranteed. Okay. It is very challenging to market and promote and live up to the expectation at the same time. And because of all these things, right, most of these products, right, all these inflation adjustment, whether if they even have it, right, it cannot be contractually binding because it's a lot of things to actually live up to. So say, for example, you ask yourself how many products out there, whether it's insurance or investments, that you see a brochure where they say that the income will go up 3% a year, inflation adjusted. I think it's only recently, I think my insurance specialist showed me this AIA kind of plan, but I think it's for a high net worth, right? But I think they're also creating a certain structure around investments, right, where they show that the income will go up 3% a year. But I have not dived into the details, right? But likely case, these are going to be contingent of some kind of performance. And in a certain way, some of them, they just don't care. There's no reasons to actually create so much problems for yourself by creating inflation adjustments to it. And because of this, right, likely case, the income payouts from these kind of plans, right, they tend to be very conservative, and very conservative is another word for low, and they tend to be inconsistent. They won't have that kind of inflation adjustments. Okay, income unit trust, right, payout tends to be inconsistent and depending on the market conditions. So we don't even have to talk about inflation adjustments. But if the fund performs and they are loaded with equities, which tends to be something is a kind of underlying asset class that tends to keep up with inflation, right? Over time, it might keep up with inflation, but the payout in the meantime, right, they might not be exactly how much you need. This is the same case for endowment and retirement plans itself. They are based on projections and payouts, right? And they tend not to be inflation adjusting. Now, there are some things called like the guaranteed lifetime withdrawal benefits, or GLW plans, right? That it exists more in the US, and it seems to hold a lot of promise that your incomes, they will lock in certain inflation step up along the way, which means that if, let's say, they step up the income, it will lock in, it will not go down anymore. But even then, some of the recent ones that I see, right, they don't have these features, or they have those kind of caveats that make them, I don't think you'll consider them as in inflation adjustments. Okay. Now, of course, some of us execute dividend or REIT income strategies. We manage it as an investment portfolios on its own, and these the income from these strategies, right? It comes from the income of the underlying stocks or REITs. So if those income they tend to be inconsistent, right? Then the overall will be quite inconsistent as well. Although if you're diversified enough, the inconsistency is reduced. But it's a question of whether the dividend is able to keep up with inflation or not. And in recent times, you can see some of the real estate investment trusts like AIMS, AMP, and all. They are able to step up their dividends as well. But some of the other REITs, right, they're cutting their dividends due to the heavier interest expense due to the higher interest rate adjustments. So net we're not sure how it is. So while over time, maybe over the long term, REITs as an asset class, they do keep up with inflation, right? But in the meantime, is it enough? Is the inflation adjustment enough for you to spend on what you need? That's a big question mark. Okay. Now there are other things as well, such as renting out properties. Properties, the income, right, they tend to go up with inflation. But it's the same question of whether it is enough for you or not. My favorite is a low-cost, globally diversified portfolio, stocks and bonds. But we know that by itself, the dividends and the bond coupon payouts, right, they are very low and inconsistent. So all of these things, the income is inconsistent. We don't even have to talk about inflation adjustments. So why can this provide some call for inflation adjustments? That's because you need someone like let's say yourself or a wealth manager to design an income strategy around it. So again, we go back to this picture itself. Can we have some inflation adjustment or not? I think it's possible, but it also means that you as a person, right, you have to intervene into this, right, to actually come out with a strategy. What's the strategy to provide the inflation adjustment, and how do you do it? Same question asked. We're not going to discuss too much here. It means that some stress rests on your shoulders to actually go about doing this. Okay. Next, we talk about whether your income lasts or not. Well, I tend to find that endowment plans and insurance product plans, right, they provide they are the ones that provides the clearest sign of fixed period projections, like how long would the income last. And there's a portion of it that is guaranteed, and the incomes, they tend to be quite conservative. But beyond that, right, whether the rest of the non-guaranteed portions, right, I think it should provide during those fixed projected periods, but most likely it's not going to be inflation adjusting. So if you look at this poster over here, you can see that it touts that for this Manulife product, that there's guaranteed monthly income for life. That the income will last for a certain fixed short period by itself. And I think in a certain sense, the insurance actually, right, they will did the work, right, to ensure that the income should be able to last over this period by itself. But in a certain sense, for the guaranteed portion, which most of the time people are interested in, right, feel that most of the income, right, tends to be a return of the capital itself. But beyond the insurance products, right, most of these products, right, they don't tell you like how long the income will last. This is because I think the payout, they tend to be inconsistent. They are non-inflation adjusting, and how much income that they can deliver, right, is based on market-based returns, how much income that they receive from their fixed income and their equity. If the income is there as long as the investment is okay, but if the investments are not okay, then probably there's no more income. Okay, how long the income will last, right, would have to depend on the strategy of the manager, the wealth manager, or you. Okay, and I don't think a lot of strategies out there, right, they have the empirical rigor such as a safe withdrawal rate, right, that tells you how long this income will last. Most often, a lot of this is purely based on the income distribution by itself. And if let's say the underlying assets they do not pick well, the managers do not pick well, it's a certain very concentrated sector and they are concentrated, and these stocks don't do well, then you might even get situations where your capital goes down faster than imagined. This is more prevalent if you're managing your own dividend strategies and you do not know what you're doing, and so you become very concentrated. You pick on the high yielding stocks, and there's a high chance that a lot of them would not turn out very well, and that becomes a problem. Your income is high at the start, but they don't last for so long. Okay, now let's talk about effort. A lot of people want these kind of solutions to be more passive, but if we look across the board, some of these products or solutions, they tend to be more low effort, such as the endowment insurance product. Unit trust by itself is quite low effort as well. If you manage to find, let's say, a trusted wealth manager and delegate all the responsibility to the person, it also means that you don't have to worry about this so much. But if you don't trust them and then you want to DIY a lot of these things, then the effort would be higher as well. So of course you can't look at this characteristic on its own. You have to factor in those previous few characteristics. While these are low effort, they might not give you what you want. Now the last thing in this kind of wealth planning things that you need to think about is whether can it scale well or not. Like, I think a lot of people, they prefer properties, right? But properties have a high capital, and that means that you have to accumulate to a certain amount before you can invest. And for a certain group of Singaporeans, you can't. It's quite challenging for them to accumulate so much that they can invest in a private property today. Okay, even some things like engaging a wealth manager, it might not be cost effective if let's say you don't have a certain amount of money. So that is why DIY solutions are popular. Okay, so we have gone through the characteristics for more of the wealth planning side, and the next is, of course, there's only one consideration, which is in investments, right? But I think it's something that is asked quite often as well. Like, if you compare, let's say, this product or this product, right, which one will actually do better? Which one can actually give you more income? People sometimes are talking about the returns, but they struggle. They think that the returns have a lot to do with, I think, the portfolio managers, but I think a large part of it deals with actually what is the kind of asset allocation. So we have a good example over here, going back to that fund, Alliance Income and Growth. If we take a look at the fact sheets, right, it will tell you like what's the kind of asset allocation. And for Alliance Income and Growth, right, the allocation tends to be 1/3 of it equities, 1/3 of it high yield bonds, and 1/3 of it convertible bonds. So if we know the asset allocation, whether it's high equities or bonds, right, how good the performance is, right, how volatile it is, right, it is usually driven, like, the managers can do to a certain degree, but they can improve the situation to a certain extent, but largely speaking, what we observe is that the returns are determined by the asset allocation. If you have property inside, your returns are based on property as well. So this is a tabulation of the performance of this alliance income and growth on this column by itself. And on the right side, right, I slapped together a composite index that is formed by 33% equities, 33% high yield bonds, and 33% convertible bonds. And you will realize that the performance looks quite similar. This is 11%, this is 15%. If let's say this performance is lower, the relatively this index performance is actually lower. If this one is negative, this one during that period is also negative. If this performance rebounds, becomes better, this performance also rebounds. So you can see it's kind of similar. And what this means is that like it's not magic lah. You have to ask yourself, like, for this strategy, if we're talking about some insurance strategy, in insurance, right, what is the underlying asset allocation? Okay, so let's go through a few of them. If we're talking about retirement income endowment products, they tend to be high in bonds and low in equities. So you won't be expecting like high returns from this. There is also certain dynamics of these kind of endowment products that makes it quite difficult for them to actually have a high equity allocation. If you look at high yield income unit trust, right, if let's say the underlying are all high yield bonds, right, then you know that how volatile it is, how dangerous is it, right, or how high of a return, right, is based on high yield bonds. You probably can look at some of the indexes to look at some of the returns by itself. And if it's a lower yield income unit trust, it's not that it's lousy or something. Most often, right, instead of high yield bonds, right, what's the underlying is more like investment grade bonds. They are bonds of they are a portfolio of bonds of higher quality. So if the manager is just distributing the aggregate coupon payments from the bonds itself, and these are higher grade bonds, their coupons tend to be lower. So they're actually doing the prudent things. If you buy and lease out properties, like 100% of it, right, it will be properties concentrated in one asset class in one region by itself. If you run a dividend income strategies, right, it might be the case that, like, it depends on your strategies really. If let's say a person, like, they will always be looking for a certain, like, kind of higher income, most likely 100% of the portfolios is based on matured local stocks. But it's also possible that some people, they run a varied strategy where their dividend income strategy, the portfolios, right, is made out of partly matured stocks, but also partly stocks that don't provide so much immediate dividend per share, but this dividend per share grows over time. So whatever the income that you get is based on the underlying, the performance as well. And of course, something quite similar is DIY REIT income strategies. Most likely you will have 100% of your portfolio in less than 10 local REITs. Some people can run a certain direct bond income strategy, which means that their capital is large enough that they buy maybe four bonds that is $250,000 each, and it's concentrated. This is a portfolio that is concentrated, and it will depend on, like, what kind of the quality of the bonds and how much is the coupons. Now, you also can have insurance plan that is investment linked plans, or some universal life, right, that is based on the underlying is based on funds itself. So you can have a mixture of bond funds and equity funds inside them, and the returns will be driven by the performance of bonds and equities. Lastly, you can also have a low cost diversified portfolio, and whatever that is inside there will depend on how much of a bond and equity allocations allocations that you decide. Okay, now because like we know that majority of the returns are generated by the underlying asset allocations, right? What this means is that you might be able to, for some of them, you're able to see how the performance is like over time. So say for example, if you have a high yield income unit trust, right? We do have, let's say, a certain kind of high yield bond index, and you can see in this chart over here on the left side, right? This is a chart of a 5-year annualized rolling returns of this high Bloomberg Barclays high yield index. I think this is written some time ago. Now probably it's called Bloomberg high yield index instead of Bloomberg Barclays. But you can see that depending on what kind of time periods, right? Sometimes your performance can be, for 5-year performance can be astoundingly good at 14%. Sometimes it can be negative 1.25% a year for 5 years. And of course, there is empirical data for those portfolios that is like more globally diversified. We have the data. And it also shows that the performance, depending on when you invest, it's also different. Okay, so at this point, right, we probably show some of these characteristics, like these wealth planning characteristics, as well as some of these investments characteristics, how you should look at these solutions out there. And if we recap, right, we can find certain kind of certain conclusions when we run through a lot of these products. That I think the first one is no off-the-shelf product can confidently promise consistent income. Okay, they probably cannot provide contractually binding inflation-adjusted income as well, and no off-the-shelf products, right, they can promise that how long the income will last. And off-the-shelf product, they tend to be quite passive to a certain extent. So that is a small win. And because they tend to be sold to the retail, right, they tend to be scalable as well. But I think an important conclusion is that because of these that they cannot give a lot of things that you want, right? That means that no suitable product. That means that you or someone have to come out with a good income strategy to actually tie them together. So this portion of it becomes quite important. Now, given that, like if let's say one of these products or these products is not the be all and all, right? What do you need to do? Now remember that at the start of it, we list out some of the wealth planning considerations, and that is where we should how we should start looking at these things. The first thing, right, is taken down from my last presentation on I think income allocation. The first thing is that you probably need to figure out like what is your requirements, like how is your spending pattern, and this is quite important because this one will drive your income requirement. If you know your spending characteristics, like what do you actually want, right, your income requirements will be quite different. Like some of these are long tenor, some of these are limited. You can be flexible with some of these spendings. You cannot be flexible with some of these spending. Some of these will need to be inflation adjusted, but some of these, it's okay not to have inflation adjustment. So this means that like not all of these income products that this off the shelf one, right, means is no good. They can be useful for some of these purposes. So if you know your income requirement well, right, then you can see like what is the ideal strategy that to have, right, to tackle each of these kind of unique income requirements. So this is how I'll look at it, the 3 different kind of strategy. Okay, now within, let's say we talk about, let's focus on this one at the bottom, right? Let's say this strategy 3. Within this strategy itself, we go back to this diagram over here. We talk about that it's important for us to have an overall strategy. So the question is, if you're managing this, right, you don't have a wealth planner to help you, right? You have to figure out, like, how should you handle this? What is the style and strategy that you use to actually execute this? Okay, you need to remember your income requirements. So say for example, right, we talk about that conservative income stream you need, right? Your income requirements is that you need you need it for an inflexible spending, which means that your income needs to be consistent to a certain extent. This needs to be long enough because it needs to last for as long as you live. It probably needs to be inflation adjusting to a certain degree, and you prefer it to be more passive in this sense. So knowing this, right, then probably one of the strategies that fits this one is something that I talk about I'll link the video below, which is something based around the safe withdrawal rate itself. It can be other strategies. It doesn't have to be this. Probably it can also be a dividend income strategy. So the question is, if you say that this safe withdrawal rate is not suitable for this purpose, right, then do you have a better strategies to deal with these kind of income requirements where spending tends to need to be consistent, inflation adjusting, and passive and long tenor at the same time? So let's say we look at another set of requirements. If let's say your income requirements can be more flexible, right, then perhaps a strategy can be that maybe you can spend 4.5% of the current portfolio value, because while your portfolio value can be quite inconsistent, right, but because the characteristics of your income requirements is quite flexible, right, that might fit it quite well. Or you can, instead of, let's say this, if you prefer it to be more hands-on, right, you can apply a dividend strategy to this as well. So these things comes before the product by itself. And after you have think through, like, okay, what is the kind of strategy to actually deal around it, right? Then in this case, we can then think about how do we implement this? What do we want to be inside here? So do we want it to be a more passive, or do you want to be self-managing it? So this is where, that if let's say you want it to be more passive, right, then perhaps a low cost globally diversified portfolio would fit something over here. You don't need so many of these. You just need one portfolio, and this is more talked about in this video over here, which I'll link below as well. Okay, now I come to near the end of my presentations, right? And I think these last few sections is how people should think about this. But and why I emphasize on this is because people seems to, what I notice is that people seems to be very lost about what they should be doing, right? Because firstly, they are unclear about their own spending pattern, and because of they are unclear about that, right, they're not sure about their income requirements, which leads them to only look at things from the product angle by itself, or they've been taken in by a lot of these kind of sales pitch. So very often the product drives they purchase the product, then they try to fit things in. And some of these products, right, there is a long lock-in for these kind of things, which means that you cannot surrender some of these policies easily. So I hope that this video, right, it gives you a certain idea that I think one thing that I bang on a lot is that these products by itself, right, of these products or these solutions out there, right, they are not the be all and all. If you evaluate them based on those characteristics, whether it's wealth planning and investments one, right, you realize that they all have their own flaws, and by itself, right, you'll be disappointed with what they give. But it also means that like you need a certain coherent income strategy by itself. So hopefully the last few slides, right, it gives you a certain idea how you add them together. But I think there is some rooms to actually like try to flush out like what how to think around some of these income strategies. So hopefully some of my subsequent videos, right, we can discuss the strategies around some of these income requirements, because it doesn't have to be something like a safe withdrawal rate. If we are able to discuss these income characteristics with these strategies, right, then we can figure out some innovative ways to actually tackle some of these financial independence problems. So hopefully you find this video useful, and if you do, right, do like and subscribe to my channel, and most likely I'll deal with a lot of topics around these kind of areas. With that, hope you enjoy the rest of your day, and I'll see you in the next video.